Robbie and David are my two panelists today, and as they weave their way up, I've known them both for many, many years, hence getting the invite, because I know they have some great stories to share and a lot of insights into the world of raising capital. And when I put the panel together, it kind of came together as I was talking to both David and Robbie, independent, but about companies that were out raising money, and they had unique perspectives, and I thought paired with how I look at the world, there'd be some value. So David is the CEO of Silicon Prairie Capital Partners, a modern investment bank inspired by investment crowdfunding and powered by automation. And my asking David to be on the panel was to provide the perspective of having an electronic platform for raising capital. So that's kind of the concept and the lens that David will bring to the panel. And then Robbie Cordo is co-founder of Smart Founders, and I know that he has at least one or two co-workers here, as does David. Also has a couple of Silicon. In fact, let me backtrack. Silicon Prairie Capital Partners people. I know there's a couple. Raise your hand. Okay, we got 1, 2. All right, so we got 2, and then the Smart Founders. I got Mary over here, and all right. So if you have questions, but you end up not talking to these guys, you can seek them out. Anyway, Robbie is helping founders not only raise capital, but grow their businesses and providing a variety of insights in doing that. And Robbie's going to come to this discussion from the perspective of being outside the company. And then kind of my part was to say, hey, raising money from inside the company is another pathway. So I can call as a co-investor, I can call as a founder, I can call as a board member, I can call as a investor. And so the way I positioned this was, hey, I'm looking from inside the company, Robbie's looking from outside, and David has the platform. So in theory, we're supposed to give you enough insights here that you all can run with that. So with that, let me make my way over and we will get started. All right, so I gave a little bit of background there on everybody. David, why don't we start with you and give me just a little bit more background and color on how I introduced you.
Yeah, I really appreciate that. Thanks so much, Rick. What a pleasure it is to be back at the Minneapolis Club and in person again. It's been nice to go several days without hearing the C word, COVID. So I'm David Duccini, founder of Silicon Prairie. We are a collection of financial technology companies really centered around the universe of helping other businesses raise capital at scale, publicly or privately. We started as a crowdfunding portal back in 2016. We're the last Minnesota-based crowdfunding portal in existence. In 2018, we became a federal funding portal, so that's regulation crowdfunding, raised up to $5 million. Same class, if you've heard of WeFunder, StarDigiN, Republic, that's what we do. And then we have a transfer agent that Ms. Barker in back runs. So a transfer agent is a real thing. We keep track of your shareholders, basically a cap table company. And then we have a broker-dealer run by Mr. Cedric Long here that does private placements, mergers, acquisitions, and also now runs a trading platform. So we're one of the few broker-dealers in the U.S. licensed to run an alternative trading system. So I'm kind of a software nerd who accidentally became an investment banker.
All right, thank you. Robbie, give us a little bit more background than how I introduced you and Smart Founders.
Okay. I'm Robbie Cordo. I'm the co-founder with Brian Stratton of Smart Founders, which is an outspin of Robbie Cordo Inc., which I had for about 15 years. And in the audience is Mary Tucker with me. Mary can raise her hand. And I've got several other partners back in the office, which is a virtual office. Al Dutcher in particular helps us with serving our clients. What we do is bring investors and entrepreneurs together. Like, I view these as investors. And
hold the mic to your mouth.
And I align them with each other as they as their needs require. And then we've been very fortunate this past year of cash flowing positively, which, having been an entrepreneur, I know is kind of important. So with that, I'll turn it over for further discussion.
All right. And being a Vikings fan, I don't know if Robbie's trying to bother me or not, but he has worn this hat many other times before. He is making it up, though. He's got the Jimi Hendrix T-shirt, so I'm a Jimi Hendrix fan, so I'm kind of going to let the Packer thing go. Anyway, David, let's jump down and start with you. One of the things that is a challenge, I believe, for your industry are the myths around crowdfunding. So talk about that a little bit.
Yeah, for sure. So one of the most common myths you're going to hear, and this actually happens to come from lawyers that don't know that the laws have been updated, bless their hearts, is that they think it's going to blow up your cap table if you take a bunch of investors. And that can be true by the numbers, but that's not really the heart of the issue. The heart of the issue is control. So they will tell you that if you do crowdfunding, then you're going to become radioactive to future financing. And the reality is that you can sell non-voting common stock in your crowdfunding round. In fact, we actually encourage people to consider doing Class C shares, which are common for their community round, but are non-voting, and that absolutely solves the question of control issues in the future. And then also with crowdfunding, it doesn't have to be equity. I know it's launched as equity crowdfunding, but we do as much debt, revenue share agreements, convertible notes. So you don't have to give up. You don't have to give up control. You can really set your terms and then decide who you want to take money from.
All right, and then another thing would be there's probably some common themes that happen with offerings that actually work. So what are the things that you see most common when the offerings are successful? Yeah,
that's another great question. So we're sort of industry agnostic, but I can tell you the one key factor that makes entrepreneurs, founders, management successful when raising capital, and it's simply this: you have to make the ask. So even on a platform like mine, you can't post and pray. You have to tell people that you're raising money. And so they won't know unless you tell them. And obviously not everyone's going to be able to invest at this given time, but then ask for a referral to someone who might. So people will first invest because they know, like, and trust you. The second wave of money is, they don't know you, but they know someone who does know you. And the third wave, if you ever get there, your go viral moment comes from found or more likely paid media attention.
All right, thank you. Robbie, bouncing to you, many times I'm guessing that you need to influence a founder and maybe try to shape their thinking, push them a certain direction. Talk about an example of how you were able to influence the outcome of an offering as you were helping somebody move through the fundraising process.
Sure, thank you. What I've found is I call myself an entrepreneur coach, and what I find is that a lot of people are not coachable. And so
I'm going to second that, by the way. However, for my clients that are in the room, it doesn't apply to you.
That's right. The core of that exclusion. But what we do is have a process where we lay out a logical path to getting funding, and some people will follow that path and some won't follow that path. And the other coaching that we do up front is valuation coaching. Is people often have an overinflated perception of their valuation, and I recently had an incident where I was not able to push the needle on the entrepreneur for valuation, and he asked me, why didn't this particular venture capitalist in Green Bay, Wisconsin, yay, I got a joke for you later, is valuation was the key issue, and bless you. The valuation was key, not the product or the service or the team even. And I'll jump ahead and just say the most important element of any effort to raise money is going to be the team. You've got to have great people, and that's what investors look for.
So we'll get to that in a minute. In this particular story, where valuation was the issue, is there a key piece of advice that you'd like to share with the entrepreneurs in the room?
Yes, know your client, and that means don't try and fit a 10-pound bag in a 5-pound bag, because if you do your homework and discovery on investors, you'll find out that they can't, often on their website, they will say, we don't do deals under or over $20 million. And do your homework, know your client, just like the old IBM Blue Sheets where you would know your sales prospect. You've got to do your homework.
I agree with that. All right, so let's talk a little bit about how companies do get funded, and then we're going to talk a little bit about how and what kinds of things might go wrong when they don't get funded. David, jumping back to you, let's start there. Talk a little bit about, say, 3 things that people need to do to get funded.
That's a great question. So this is, I want to read this because I think it's really salient. And this might come as a complete surprise to many of you, especially if you're like an entrepreneur, but here it is. Here is the magic formula for raising capital. 1, you have to solve a problem someone has that is willing to pay to have it solved at a price point in excess of the cost to solve it.
All right.
The second piece is then you have to have an easy to explain business model. If we talk about, first of all, do you have a clear need for capital? If I don't know why you need the money, you're going to have a hard time explaining it to other investors, right? So a clear need for capital, right? You have to have an easy to understand business model that explains how you do or will make money, and please demonstrate some sense of obligation to pay your investors back. Like, they are not like, the pellet bar in the rat maze where you just keep pushing the pellet bar, right? Look, and so I will tell people, like, if you're not willing to ask your own friends and family for capital, you don't get to ask mine. Then lastly, I was just saying, go back to the referral piece, right? Again, you have to tell people that you're raising capital, and you have to make the ask. This isn't social begging. You're making people aware of an opportunity to make an investment, and you're inviting them to participate if they want to. Not everybody can participate at this particular time when you just happen to ask them, but ask for a referral, right? People, to Robbie's point, people invest in people first, right? They invest in people they know, like, and trust, and then your second wave is from the referrals. You ask for a referral. They don't know you, but they know someone who does know, like, and trust you. And then your third wave, if you ever get there, comes from found or paid media attention.
Yeah, I see that on the referrals all the time. If people ask somebody and they say no for whatever reason, and then end a sentence, and instead of saying, they have the opportunity to say, hey, you have 1 or 2 or 3 people that you think I might reach out to, or firms or whatever. Yeah. All right, Robbie, back to you. You mentioned a little bit about the people and the teams, but talk about your kind of top 3 things that you believe companies need to do to get funded.
What you need to do is have product market fit. You need to have the kick-ass team, and you need to be a Packer fan.
Yeah, one of the things when we were talking on the phone ahead of this, you talked about fundraising and marketing from affinity groups. So that's a little bit like what David said about asking referrals. So if you're running in affinity groups and talking to people who are thinking commonly or whatever, that's a value too, correct?
Absolutely. You want to make sure the people have a resonance with the problem you're trying to solve. For example, I had a client who had a sleep solution, and the way we would sell it is we would ask people, do you know anybody who has trouble sleeping? And they would inevitably raise their hand. Now, I won't say why that company didn't, in my opinion, get funded, but because they've been they've come to this forum before. But there's so many factors involved in the no that it's really hard to get a yes. And you need to understand the objection. One of the key things, your job as a salesperson, whether you're selling software or you're selling hard goods or you're selling capital, is you need to understand the objections. Why are they not choosing you? And then you can respond to those objections. So it's a no is not necessarily a bad thing.
No, especially if it's a fast no.
Right.
The no that drags on, that's the killer. And the fast
The
no.
Minnesota no.
Yeah.
Get to know, exactly. Get to know faster.
Get to a no faster. That's a good thing. All right, so I'm going to throw out three. I wrote down a compelling story. Who's read the book, The Brand Story? Story Brand? Yeah, a couple. Anyway, people buy an emotion and then they justify it later with facts. So you have to be able to tell a good story. And have a new member of our group here from the press. We were talking about writing stories earlier. So telling a compelling story is my number one. There's a risk-reward profile. It's tied in with the market, the valuation, a bunch of other things, but I don't remember which colleague over here talked about valuation. But most of the time, the entrepreneur does overvalue what they have. So then there's a risk-reward profile that gets out of whack, and basically you need to compete across this risk-reward profile against all the other deals because that's how investors are looking at it. So it's not just your company, it's what are the investors getting relative to the risk they're taking. And then number three, I think you should ask yourself, would your customers and distributors invest? And if they would not, why not? In the best case scenario, your customers and distributors are going to be reaching out to you saying, that's really cool, can I invest? And so what do you need to do to get the people closest to the product asking you either to invest or how they might invest or will you take their money? And so if the people who are actually using the product aren't asking those kinds of questions, then maybe dig into that a little bit. There was a older guy many years ago who gave the great analogy of, are the dogs eating the dog food? And it's just a just good reminder to focus on the people closest to the product. Okay, so those were my quick three. Robbie, working back your direction, what would you say are the three reasons why people do not get funded?
I think the three reasons they don't get funded, one, I mentioned valuation before. It's a hot button for me. Number two, arrogance. There is a sense I've experienced in Minnesota in particular, where I've done most of my work, where there's a feeling of a right or a privilege. And I've actually heard of entrepreneurs getting angry with their angel investors because they didn't write a check. And
It's the Keeler effect.
The what effect?
It's called the Keeler effect. We think we're all exceptional.
That's right.
Remember to talk in the microphone.
And the third thing is people don't treat the money as if it's their own, and you need to ante up the same level of care for other people's money as you do for your own money. And that's all about cash flow, cash flow, cash flow.
And I done jump on that one too. When you walk into somebody's office and they've spent too much money of the money they've raised on how their office looks, yeah. Okay, David, how about you? Three things that happen when people don't get funded.
Yeah, for sure. And I got to give a shout out here to our friend Tim Murray. Did Tim make it out?
He did not, but I talked to him a couple of days ago. So anyway,
that's awesome.
He's definitely a long-term supporter.
Yeah, for sure. So Tim Murray's awesome. So Tim, not only does he run one of the best well-run meetings I've ever seen, like clockwork, the guy's a true gentleman, but he said, look, and he's got a lot of experience trying to raise capital, especially from the auto-do's in Minnesota. The auto-do's are the people that are long on advice and short on cash. What you ought to do is this, right? So he said, David, there's only three reasons why people are not going to invest. They're not going to give you money. He says, one, they don't like or trust you, right? It's going to be really hard to overcome that, right? They don't like or trust you. The second reason they're not going to invest is, assuming that they like you, and I'm likable, the second reason they're not going to invest is they don't like or understand your business model. Like, they don't know how you business to make more business so that you can business and make money, right? And then the third reason, and he said this is actually the number one reason, this is they're not liquid. So private investors are constantly doing satisficing. It's opportunity cost. They're constantly looking and saying, okay, but if I give you my money, that means I can't give money to somebody else potentially. And I can tell you, our platform, we run about a dozen angel groups. These angel investors are not writing big checks. They're writing like $5,000 checks. Like above $5,000, they'll have to stop and think about it. Now, the nice thing is that these angels can pool the money together. They'll show up as one line on your cap table. But again, they don't like or trust you, they don't like or understand your business model, or more likely they're just not liquid. So I don't take it personally.
And on that last one about they're not liquid, and Robbie brought this up earlier, is to do the homework on who they are and what they invest in. If you're trying to raise early stage capital in the medtech world, and you're talking to a later stage IT internet company, you're just going down the wrong path.
Right, and some people just don't invest in like consumer packaged goods. Like, I love your ice cream. I just don't know how you're going to make money with your ice cream. So
right. All right. So my three on thinking about this, I've often used the term dead on arrival, meaning you didn't even really get a chance to pitch. Some of it would be just what I said. You're talking to the wrong person. Another might be that your elevator pitch doesn't entice them right out of the batter's box. The opposite of that movie where the lady said, "You had me at hello." You actually lost them at hello because you didn't have your stuff together. Can you articulate what you're doing in a short, concise, compelling thing? Get them to ask questions like, "Why? Tell me more." And if they're asking you why, tell me more, that's what you want to hear. So anyway, dead on arrival, you just missed right out of the gate. Second one would be lack of understanding about the future value of a company. So we're starting from, as we all have said, almost everybody overvaluing what they have from the get-go, and then an investor has to make a certain rate of return, and because they've overvalued it on the front end, makes it harder to make money on the back end, and you can't articulate how the investors are going to get out in the back end and at what price, and are you going to get the kind of return that investor has to get. So there's a lack of understanding of an investor goes in, an investor goes out, and there's some number of years, and there's some multiples that have to happen on that money that create a minimum return. And so lack of understanding of that math, and believe me, you can do that math very fast, and often somebody's telling me their pitch, I'm already running through, hey, they told me their pre-money value, I'm thinking where they might be in the future, and 30 seconds, 60 seconds later, while they're talking, I've already fast forwarded, like, they're not going to make it. They can't get there. And just so you know,
there's nothing left for you.
What?
Right? There's nothing left for you.
Yeah, there isn't. And that again, it's twofold, not understanding the back end and overinflating what they have in the front end. And just so you know, somebody needs to make 5 times their money in 5 years to have a 38% IRR. And if you're doing something early stage with risk attached, that's kind of the floor. And it seems crazy, but that's the floor. And so you better show somebody how they can make 5 times their money in 5 years, or more, 10 times their money. And obviously the 5 years, you can scale it up or down, but not understanding how companies get valued in the future and giving an investor the kind of returns that they need to have. And each investor is going to have a different risk profile and risk tolerance, which goes back to kind of understanding that, as I mentioned earlier. And then the last part I wrote down is nobody will tell you that the due diligence process is time weighted, but part of the reason investors take their time looking is to create a little bit of distance from when you say you're going to do something and to see whether or not you actually do it. So they insert time to watch you perform over that time period to see if you're actually doing what you say you're going to do. So it gives them an opportunity to assess whether you really are going to do what you say you're going to do. And so that time is inserted a little bit on purpose. So anyway, all right. So those were my 3. We do have everybody listen to me this time. I have to say, very nicely done. often say, okay, this is how much time you have, and talk concisely, and they both did a very nice job. So what that means is we left enough time for questions, and so we have plenty of time to answer people's questions. So, Eric.
Thank you, Rick. Question about, Mark Twain always says, I don't care what the return on my investment is, I just want my investment back. How can you, as when you're working with investors and the recipients of those funds, can you show or should you show a pathway that actually shows that money coming back to them, or is it just too risky to go there?
So let me restate that in case somebody didn't hear it. Basically is, how do you make sure somebody gets their money back, and how much of that should you bake into your story? And I'm going to add a little bit to that, and then let these guys throw out an answer. Is, I think absolutely you want to paint the case of kind of the bare minimum. What, in a worst case scenario, what happens here, and where does that leave the investor? So I think absolutely you bake that into your story. And then the second part would be, that's part of why somebody should invest, because if the downside scenario has some protection and isn't that bad, you've eliminated the swing and a miss, and you get nothing, and et cetera. So I think painting a picture around how somebody gets out in a scenario that isn't the hockey stick and what that looks like, I think that's very valuable. Gentlemen.
Yeah, so this is a quote by my affable business partner, Cedric Long here, who runs our broker-dealer. He said, just kind of flippantly one day, he's like, an investment without an exit is really just a donation. So yeah, I mean, liquidity, we think liquidity is everything. It's one of the things that we've been after is creating essentially a secondary market. But we counsel our clients to think about putting rights of first refusal into their operating agreement or bylaws. That gives them the right but not the obligation to buy their stock back. So that's one sort of level of part of the story. Anyway, to your potential investors, like, well, I'm going to have a right of first refusal to buy your stock back, and I might buy it back at 50 cents on a dollar, right? Sometimes you just might want to get out, right? Because again, the worth of a thing is the price it'll bring. I would say that also the other things you can do are figure out what that exit strategy is. Companies are staying private longer, and a lot of times they're not going public at all. Like the average transaction is now like 10 to 12 years, not 5. I mean, we love the 5 and 5 for sure all day long, 5 by 5. But the reality is that most companies are, they don't have a liquidation event, which is usually an M&A transaction, by the way, for like 10 to 12 years or so. So I think the part of the story is one. Absolutely, we encourage our clients to have a right of first refusal to buy their stock back because maybe you want to get an agitated investor off your cap table, and then 2, think about potentially liquidity options, and that can actually be done in subsequent funding rounds. So you absolutely have the right to declare as part of your next round, I'm going to earmark 10% of the money, 20% to act as a floor stabilizing bid to buy my securities back. So you can absolutely declare you're going to have selling shareholders in a subsequent financing round. So I would say that's also part of the story. And then also I'd say part of the upfront story is like, okay, look, this is our plan. We're probably not going to go public. We'd like to, but we're probably not going to. We think that we have a strategic buyer sometime in XYZ. I think that would help mitigate a lot of that risk and then improve the kind of investor relations I think you want to have.
Robbie, how about you?
Well, I think the IPO path is a facade for most people. Oh, great! That's my phone. It's Forbidden Planet, and so.
All right. While he's doing that, I'm gonna add to the exit. There was an entrepreneur who sought me out, I don't know, maybe 4 years ago or so, and she had been making her way around talking to angels and angel groups, and everybody was saying no. And basically the big answer was it's not going to be big enough. To what they just said, which I totally agree, the reality is highly unlikely anybody is ever going to bring a company public. Back before my hair got gray, you would work on public offerings that were $5 million, but that time is long gone. Anyway, so M&A is the way out. So this one entrepreneur, everybody had been telling her, we're not going to invest because it's too small. So I call an M&A buddy who's been in the business for a million years. I describe the company. He goes, you get to 3 to 5 million in sales, you can sell this thing all day long. Now, whether we want to exit at 3 to 5 million in sales, that's a different matter, but it was in a regulated industry with a lot of private equity money. Everybody's looking for bolt-ons, and it's just a path to liquidity as fast as you can be. So in that market, yeah, maybe it doesn't turn into a .com darling, but if you want to grow a business to 3 to 10 million, 20 million in sales and sell it and do quite well, you really need to look at where you're going to sell it and who you're going to sell it to. And so everybody said, no, no, no. And this guy just said, absolutely. I'm like, I'm in, because we can get your business to 3 to 10 million in sales. So anyway, Robbie, back to you.
Well, one of the things that I see as erroneous is people don't see the opportunity to do a roll-up of themselves with other companies in the space. And everybody talks about getting an exit themselves and getting acquired. And what I see is, in a number of cases, the opportunity is actually to roll others up around you. And it takes a lot of guts to do that. But that's something that's often available to the entrepreneur.
I would also add too, like, reach out to who you think is your competitor. Like in our space, we don't have competitors; we have contemporaries.
Right.
And so I think there's obviously, yeah, I agree. The roll-up strategy is really a good opportunity. Go form a holding company and go start hoovering up your contemporaries.
All right, one more question right here.
You mentioned like a higher multiple for risk. For example, we're in the cannabis space, the high risk. What multiple would you assess?
Question was multiples. This gentleman happens to be in the cannabis business, and specific multiples to your business. Specific to yours, I would say, hey, let's have an offline conversation. But the more global question is multiples across companies. I'll give a quick answer. I'll let these guys talk. Different industries definitely have different multiples. And some industries are measured based on revenue, and other industries are measured based on profits. Big difference, right? 5 times revenue or 8 times profits. Big difference. Do the math. And so to try to sell a company or raise money in a company that doesn't have the same kind of high-end exit multiples means all the more that you have to value it appropriately on the front end. And investors aren't stupid, so they're going to figure it out. So you need to know your story. Are you in an industry that's measured on revenue or on profits? And then that can dictate it. But given that, look at where you think you're going to be measured or valued 5 or 10 years from now, bring that back to today and see how that stacks up relative to where you're trying to raise money and what kind of returns people can get. All right.
So I know of a situation in the cannabis space where the gentleman sees an opportunity to roll up a bunch of small regional cannabis operations to make something bigger, and that's execution. The other final comment I want to make: you can have grand plans, but if you don't execute, and I learned this, I worked at a company called Prairie Research many years ago, and Prairie Research ultimately failed because of poor execution. There was never any doubt they had brilliant engineers and brilliant ideas, but it was ultimately execution. And that's where I think the operational people in the room are undervalued. We've got to have good operators, or those of us with grand ideas aren't going to get anywhere.
Unless you're actually inventing anti-gravity, you're going to have comps in the space. And those comps change year over year. It just kind of depends on what's in favor. But yeah, it's going to be based on potentially revenue, number of eyeballs seeing your website, retained earnings. Right? There's different formulas, and there's actually some well-known databases that can help you go and calibrate that stuff. But yeah, if you're really interested in what the valuation is, depends on what stage you're at. Like if you're looking to exit, then yeah, that's an important question. But if you're thinking about growth, to Robbie's point, not only can you do horizontal integration, you can go vertical. Like you can say, okay, we're in cannabis, but we're also going to be in dispensaries. We're going to be in extracting THC for inclusion in sodas. We're actually produce our own sodas, that kind of stuff. And a lot of this stuff can be just done under white label. Like you don't have to own all this infrastructure. It's really about the brand, and there's more power in that than there is in the actual manufacturing, unless you've got some secret sauce that can do it at a price point cheaper than you can buy it.
All right, quick one.
For Robbie, I know you've done a lot of work helping entrepreneurs hone their pitch, refine their pitch. What is it you do, and how important is that elevator pitch?
Okay, that's a dangerous question because we're really close to 1 o'clock. So the question, though, for everybody to hear would be how important is the elevator pitch and what specifically does Robbie do? But I'm not going to give him permission to answer that question because of the time, and I want to do kind of a lightning round thing here. But in a few words or less, both David, for you too, Robbie and David, a few words or less, how important is the elevator pitch?
So going back to the three things, do you have a clear need for capital? Do you have an easy to understand business model, explains how you do or will make money? And do you have some sense of obligation to pay your investors back? That's our fast filter test on the elevator pitch. And then we'll come and see an actual pitch deck.
I agree.
Good. He listened to me when I was talking to him on the phone. Look at that. And then I would also say, and I said it earlier, which is you want the person that heard it to ask a question, like, cool, tell me more, or hey, can I see your deck, or whatever. So do they ask you a question after you give it? Okay, lightning round, just a few words or less. Given what you think about the future, what little nugget of advice would you give the entrepreneurs out in the audience?
There are two words repeated 3 times that mean everything. Cash flow, cash flow, cash flow. That's all that matters.
Ship it. Don't let the perfect get in the way of the pretty good, right? You got to be ready and also be prepared to pivot. But you just ship it. The chances that someone even sees your ugly baby are very low, and you can very likely, I'll release something on Friday, and then I'll update the thing by Saturday, and by Monday someone will actually look at the thing, and I've already fixed it.
All right. Again, lightning round, very short answer. What piece of advice would you wish you would have heard earlier in your career?
I wish I had known that my competition is my potential partners, what I call co-opetition. Partner.
Buy Bitcoin. No, seriously. Protect your time, money, morale, and focus. You can have 4 jars. You can borrow some from each one, but you can't run on empty. Time and money, people know. Morale and focus. You have to protect all 4 of those.
All right, last question. What's the one thing you'd like the audience to take with them regarding today's discussion?
My final thought is that don't think of your competition as the people in your market space. Think of the competition as the other people in this room who are trying to raise money and take it away from your mouth.
Which goes back to the risk-reward profile, and you're really stacking it up against all the other deals they're looking at. All right, David.
All right, final thought is solve your today problems, right? Just solve your today problems, right? People tend to focus on problems that are so far out that they may never get there. And that goes right to the heart of fundraising. And I mean this sincerely. Solve your today problems, right? If you need the money and you've got a good opportunity to get it, don't run out of runway waiting for that white knight to show up and make all your dreams come true.
All right, last thing. There are a couple of people in this room that support the entrepreneurial journey of folks looking for money. So if you're in the business of helping people raise capital, raise your hand, nice and high. So all you entrepreneurs out there who are looking to raise money, you now have seen, pushing 10 bodies that you can go up to after the fact today and talk to them. Again, April 11th is our next session, cybersecurity and data protection. We're going to try to use it as a facilitator to business, as opposed to, trying to scare everybody, even though there's good reason to be scared. Hope to see you on April 11th, and let's thank our panelists.